Hey, Craig from Wealth Minus Wall Street. Today, I want to take a look at comparing real estate versus Wall Street investments. And what does the math tell us in terms of our retirement plans? So, before we jump into the numbers, let's just assess what we call a real estate retirement gap. So, a lot of people that we speak with, they don't really consider real estate, owning private real estate, income producing real estate as a viable retirement strategy. And some of the reasons we think that's the case is one, well, financial advisors don't want you buying real estate because it's a competing asset class. So they make less money if you buy real estate. So we'll go into some of the tactics they use just to try to talk you out of it. And then realtors aren't really trained in retirement planning. So, when they come in and look at investment properties, they're talking about, cash flow today and how you can generate income today. And of course, we don't think that's a bad thing. But if you position real estate for retirement, in our opinion, it becomes an income accelerator. So it's a great way, especially if you feel like you're behind in your retirement planning, to really increase income in retirement. And don't worry, I know I'm scaring people already. You don't have to be a landlord. So let me just, well, I'll explain more later, but just don't let that impact just understanding kind of the numbers that we're going to walk through here um, when it comes to real estate and retirement planning. So first off, it's funny because all the advisors that talk you out of real estate, well, some of the firms that they work for are gobbling up single family homes by the billions. Um, Blackstone, Goldman Sachs, the last one, 60 billion housing grab by Wall Street. It's happening. They're buying up single family homes. So it should give you pause and say, well, wait a minute, if the so-called smartest people out there in terms of investing and managing money or buying single family homes, shouldn't I consider buying single family homes? And we think the answer is, of course, you should. Um, Invest like the institutions. This holds consistently. Endowments, pension funds, uh, just institutional money. They have usually about a third to half of their portfolio outside of Wall Street control. Okay, so again, if we follow the smart money, what are the people with control of the most assets? What are they doing? They're investing a good portion outside of Wall Street. Well, why is that? Well, this is just an example of taking 20% of your portfolio and investing in what's called alternative investments. It can be things like private real estate or private equity or commodities, things like that. In our purposes, we're going to put alternative investments as private real estate. But what it does is it increases return and reduces risk, right? That's what we're all looking to do. How can I maximize return while minimizing my risk? And this just shows by taking 20%, that blue line, you just see the column because it's higher in the chart, that means it's more return. And then if you look at those little, bullets, they're slightly to the left of the red, which means you're taking a little bit less risk. So the big picture, this is why real estate should be a consideration for even your portfolio. The other thing that I think is important to notice that real estate in what we've seen has really changed over kind of the last 10, 15 years, especially. Real estate's moving a lot more closely with the stock market than it ever had, right? Real estate used to be slow and steady, wins the race. Well, once we kind of got into that financial crisis, where people were speculative on housing, real estate's kind of changed a little bit. So you're getting the growth that we've typically been inclined to get from the stock market. You're sort of seeing it in real estate. So that I think has changed the calculus a little bit as well, because that upside is there, and then it's significantly it can significantly improve the income you generate too. So it makes it pretty compelling as a retirement story. So let's do the example here and walk you through some real numbers. So let's assume that you're going to retire in 15 years, and let's assume that you have $200,000 saved for retirement. And we're going to say you have two options. Option one is to just put that in your typical diversified Wall Street portfolio. And option two is you're going to buy 4 investment properties at about $250,000 each, $50,000 down, and that's going to chew up your $200,000. Now, right off the bat, you should be thinking this is the power of leverage. Is with 200,000, you've now generated $1 million of assets. What we're going to do, and why we picked 15 years, is we are going to finance these properties over 15 years, so they're completely paid off right at your retirement age. Okay, so to get to $1 million in 15 years, what has to happen to the Wall Street portfolio? Well, the Wall Street portfolio needs to grow 11.5% a year just to get to $1 million. Okay, we're assuming with the 4 rental properties, we're just assuming that the tenants paid down your mortgage and there was no growth. So we're assuming no growth here. We're just assuming your $1 million is going to be $1 million at the end of 15 years. As I just showed you a couple slides back, the probability of that happening is pretty small. Most likely, you've experienced significant appreciation in these the value of the rental properties. But again, we're just going to assume, just to compare apples to apples, just to get to $1 million, 11.5 versus 0. Sorry, that's just the chart we just went over. Again, refreshing you that the likelihood of getting 0 versus 11.5, it's not real. So is 11.5% realistic? So this is a chart that we got through Dalbar. Dalbar is a company that analyzes investor returns. And they put these reports out, and usually the findings hold that you're seeing here. The average investor typically underperforms the benchmark. So that gold is what the average investor gets, and the paler yellow is what the benchmark does. So look at 20 years, because again, we always want you to think long term because we're talking about retirement. In 20 years ending 2021, the average equity investor made 2.88%. The index did 5.62. Well, that's a huge difference, right? That's nowhere near 11.5%. And even in 10 years, you're at 9.66%. That's still a huge difference. 2% might not seem like a lot, but compounding over that long a time frame, it's a huge, huge difference. So it's not very likely that you're going to get that 11.5% over a long time. This is something else that's interesting. Saying the secret part out loud. Richard Bernstein, who is a former chief investment officer at our strategist at Merrill Lynch, he basically said what's shocking is that simply by investing, most people actually made themselves poor, just shooting themselves in the foot over and over again. And that's kind of what we found in the Dalbar study, right, that we just showed, that the average investor does worse than the benchmark. So again, you should consider, as a diversification tool, protecting yourself from this chronic underperformance. All right, so now let's talk about income, because remember, in retirement, our opinion, income is what we really need to focus on. So assuming that we got to that 11.5% and that Wall Street portfolio grew to $1 million, you can only generate about $28,000 to $40,000 a year. Where do we get that number from? Well, a lot of major financial institutions have what you've probably heard of a 4% rule. So you can withdraw 4% of your portfolio, and there's a pretty good chance that money's going to last during your retirement years. With interest rates so low for so long, I know they've crept up recently, but they ratcheted that down and said, to be safe, you really should probably only be pulling out 2.8% of your portfolio just to help offset the volatility in where interest rates are. So that's between $28,000 and $40,000. The rental properties, the 4 rental properties, and these are projections from an actual client of ours. As these houses get paid off, he should be able to generate about $105,000 after all his expenses. Because remember, there's going to be no mortgage at that point. So taxes, property management, those types of things. He should be $105,000. Pretty significant difference, I would say, right? So the income is much more powerful with rental real estate than compared to what typical Wall Street allows you to do. So remember, I was a former financial advisor. So here's the pushback that you get. Here's how advisors are trained to talk to clients about bringing up real estate. First, they're going to say, well, just buy a REIT, a real estate investment trust, right? You get the exposure. You don't have to do any work. You have to be a landlord. It's great. Well, here's the problem. It's not really diversified because as we've seen in years where the markets do poorly, the markets typically, go down collectively. So it's not really a diversifying tool. And first of all, you're not getting exposure to single family residential, right? Most REITs are commercial, industrial, healthcare. They're more in the commercial space, which is a space that you need to be concerned with right now. You're going to make less income, right? Because you don't own the property. And probably the most important thing, you lose all the tax advantages, right? We didn't go into this video about all the tax advantages you have with real estate, but they're numerous. So REIT isn't it's you're not comparing apples to apples right there. Then they'll talk about vacancy. What if it's vacant? What if you can't rent it out? Well, the New Jersey vacancy rate was 2.2%, in PA it's like 6.3. So yeah, could it be vacant? Sure. But you have a higher probability of losing money in the stock market than you do with vacancy rates. What if it needs major repairs? Of course, you're going to need to make repairs over the years. It's tax deductible. But that's just part of owning real estate. What if you need to evict someone? You get that a lot. Well, our solution, we invest in really 2 or 3 markets that really limit the need for eviction. Again, we can explain those markets in more detail if you want to schedule some time to talk with us. And you don't want to be a landlord. Of course you don't. That's the silliest thing I ever hear. Why would anybody want to be a landlord, right? So we have a turnkey property management solution that we embed into our projections for any property that you might want to consider. So you don't have to use us as property management, but we're trying to make it as passive as possible. Well, let's give our pushback on Wall Street. Right? Well, what if I lose 50%? It happened twice in the last 20 some years. What if I don't average 8%? Right? So a lot of these retirement plans that you'll see by advisors, they'll grow your assets 8%. What if you don't get that? Right? We just showed 20 years the Dow bar's at 2.88, not 8. Well, what do I do then? What happens? What if the market doesn't go up for 10 years? Oh, that could never happen. It already did. 2000 to 2009, the market was essentially flat. What if I can't generate enough income from my portfolio, right? So we can play the same game. We can push back on Wall Street. At the end of the day, here's the thing. Every investment has a risk reward criteria, right? We just want to give you the unbiased information to help you make a better decision for you and your family. And here's the other thing, right? With retirement planning, we always say that there's a lot of uncertainty that goes in a retirement plan because nobody knows what the market's going to do. And at the end of the day, financial retirement plans that Wall Street shows you, it's all based on market performance. We have no idea what the market's going to do. That doesn't provide a lot of certainty. With real estate and the example we just went through of paying down a mortgage in 15 years, we have an amortization schedule. So it gives a little more uncertainty because each year you can say, okay, this is how much equity I'm gaining. My principal's getting paid down. I kind of see the light at the end of the tunnel. Again, it's not to say that there's not going to be hiccups along the way, but from a planning perspective, in my opinion, having an amortization schedule should feel more comforting than just relying on what the market's going to do year in. So just as a summary, we just think you should consider real estate and your retirement plan. We think we can make a pretty compelling case on how it can improve retirement success because it's going to reduce risk. It's going to increase income. Like I said, it has tax advantages and tax advantage not only for you, but passing it to the next generation that we didn't talk about today. So if you just want to learn more about how potentially real estate could fit into your overall process, my contact information is here. We'd love to have a quick discussion with you and also answer any other questions that you might have in your retirement planning journey. So thanks again for listening, and have a great day.